Hi, I know I'm early. Normally I said I would send it out on a Monday, but I'm sending it out on Friday because I want to give you a heads up about a possible turning point in the US stock market. Let's first provide a bit of a context. The stock market and the real economy are totally divorced at the moment. You've got the stock market going up as if there's no tomorrow, and you've got the economy heading south. Now, why is this? The reason is the great amounts of money that is being thrown by the Federal Reserve and other reserves into the economy to try and keep it from going into severe recession. In the past, when you've had these sort of crises, these financial crises, like long-term capital management, the crisis of 2018, and so on, the government printing money has been able to keep the recession at bay. I don't think that this is that kind of recession. What we're having is a health recession, and throwing money at a health recession is not going to solve the problem. What we have at the moment is the virus, COVID-19, that stops people from going to work. So if you're producing a car, it's very difficult to stay within proximity of the other worker and still produce the vehicles, because otherwise, if you're close to them, you're going to end up with a virus. We are seeing this effect now in the United States. It was broadcast with a great deal of scenario that, hey, we're going to open up early. We're not going to let the virus stop us. But now, and of course, we've had the protests, and now we are seeing the virus numbers increase. So if you keep track of this on the news, you're going to see that the 22 states have exploded to the upside in terms of the virus. A number of states are held stable, and a couple of states have gone down in terms of infection. But 22 states are accelerating to the upside. And if I'm right, given the protests that have been happening, you're going to see that number increase dramatically over the next few weeks. This recession, if we can call it that, will not be abated until such time as a vaccine is found for the virus. And that looks to be about 18 months away. So that's the context. Throwing money at the virus is not going to solve the recessionary problems. We need to find a vaccine. And until we do, the recession is with us. Now, why do I keep calling it a recession? Well, let's now turn to the screen where I'm going to show you a service that I subscribe to called Shadow Stats. And I find it very, very useful in terms of identifying fundamentals for me. So let's have a look at that. And now what you should be seeing is this, let me just get this, is this declaration that the National Bureau of Economic Research declared a virus occurred in February 2020. So officially, the U.S. has been in a recession since February 2020, and it will continue to be in a recession until it hits the trough and starts to explode to the upside. If that is the case, if in fact we are in a recession as far as the U.S. is concerned, then why aren't we seeing this reflected in the unemployment numbers? So let's turn to that. Let's scroll down, and we'll see here where it said that the reason why the numbers were so good, let's put it that way, was because a seriously flawed pandemic savage household and payroll surveying. In other words, the numbers are wrong. And even the Department of Labor Statistics said it should be closer to 19 instead of the 13 that they reported. In fact, if you follow Shadow Stats, the number is closer to 24% unemployment at the moment. Now let's put that into a bit of perspective. The peak unemployment rate in the Great Depression in the United States was 24.9%, 24.9, and we are already at 24%. So that's the context. At some point, the stock market is going to realize that they are in a recession, that the printing of funds will not stop it from going south, and the crash will come. So that's the reason why I'm putting this out early, because there's a possibility this acknowledgement may start in the coming week. let's now turn to the charts, and let me just move this to one side, and let's go to, and so what you have here is what I call an expanding terminal on the weekly chart, A, B, C, D, E, and the expanding terminal is a very useful pattern for me because it has specific repercussions. It tells you specifically what it needs to do in order to confirm it. The first thing it needs to do is it needs to go above. It doesn't have to close above, but it has to go above this second trend line. Following the penetration, what I call an overthrow, the market then has to have a series of very strong down days. So you'll know that this pattern has started if after the market throws over, there is a very strong, larger than normal range closing near the lows. That week and that day, actually you can do it to the day, you can see this throw over and close near the lows on a daily chart, will tell you that this pattern is signaling that a top is in place. It also is a good pattern because if the market exceeds, if the market closes, has got a bullish conviction close above 10,376.056, then this pattern is negated. It's invalidated. So very clear. What does it have to do in order to tell us it's validated? What does it have to do in order to tell us that it's not validated? I also subscribe to a service called the Market Timing Report for Cycles, and I find that incredibly useful. And it's got 2 dates we need to look at this month, the 19th and the 26th of June. Given where we are in the terms of the pattern, we're so close to the second trend line that I think the 19th will be better than the 26th to mark the peak, assuming it comes. What ideally like to see is a couple of days of the market moving down sideways, and then next week the market kicks up above the second trend line, and on the 9th, plus or minus 1 day, the 19th, sorry, plus or minus 1 day, the pattern starts to accelerate to the downside. There it is, guys. Hopefully you'll be able to make use of this information one way or the other. Thanks, and we'll see you next week. Bye-bye. Ciao.